Hello viewers, welcome to my channel. I'm Hasham Ali Khan. Now in this video I'm going to explain about the financial derivative futures contract. Last video I have explained forward contract. In examination you may be asked a theory question regarding what are forward contract, what are future contract, what are options, what are swaps. All these are the derivative instruments which are used by multinational companies to hedge, to protect the business against the risk of loss. So again I repeat, theory is very important apart from problems. In the coming videos I'll do the problems also. But if you have not watched the theory, I suggest you go to the playlist of my channel, select the subject International Finance. Select the videos of what is foreign exchange market, what are the, different types of markets. We have spot market, forward market, apart from that participants, all these things I've explained. Now in this video, futures contract, what is the meaning, what are the features, what are the advantages and disadvantages. So if you think that these videos are beneficial to you, give a like to the video, share my channel and subscribe if you have not yet subscribed. So before explaining in detail about the futures contract, take the screenshot of the points which I have written on the board, then I'll explain every point in detail. So before starting futures contract, just we'll recap the points regarding forward contract. A forward contract is a contract where the buyer and seller will enter into a contract to buy or sell a particular commodity in future. The agreement is made now, the price is fixed now, the quantity is fixed now, but delivery will take place on a future date. Exactly similar, the future contract is also same thing. In future contract, two parties will come together, they will make an agreement, they will make a contract that on a particular date in future, one party will deliver, the other party will receive some commodity, some instruments, financial instruments or currency. So what is the meaning? It is a contract for future delivery of specific quantity of a commodity or given currency. That means this future contract can be made for anything, any commodity or currency or any other financial instrument. So it's a contract for delivery for a future specific quantity with price fixed at the time of the contract is signed. Both the parties will make the contract, will fix the price. At the time of signing the agreement, they will fix the price. That on a future date, one party will deliver, the other party will receive a particular commodity or particular currency. Now, forward contract is also same. Then in the next video, I'll give the comparative differences between forward and future. Most often asked question in examination is what are the differences between forward and future in the next video. But right now, you remember what are the features, what is the meaning, definition. The contract is traded on recognized future exchange and the gains and losses of the contract are settled each day. This is the peculiarity of this instrument, that this contract, futures contract. The contract will take place on a recognized future exchange, just like stock exchange. Stock exchange is a place where securities are bought and sold. So future exchange is also there where future contracts are made. And secondly, the daily gain on losses will be adjusted on daily basis. In the forward contract, the profit or loss in that contract will be known at the time of maturity. But in case of future contract, the daily profit and gain will be calculated by the exchange authorities and will be debited in the account of one party and credited in the account of another party. Now, currency futures are standardized agreement. We are discussing about currency futures, not for commodity futures. So, currency futures, the contract is standardized. Standardized means everything is fixed by the exchange authorities. Simply the parties have to see whether it is suitable for them to enter into contract or not. They cannot make any deliberations, any arguments, any discussion. Whatever price is there, according to that price, they can enter into contract. Standardized. Agreement to deliver or receive a specified amount or specific currency at specified price and the date. Both the parties, one buyer and seller, will enter into a contract in the futures exchange, and they agree to buy the currency and to sell the currency. One party has agreed to buy, another party has agreed to sell a particular currency on a particular date and at a particular price. The contract is entered. Now, the buyer of the future contract receives the currency while the seller of the futures contract will deliver the currency. Just like any other buying and selling, trading agreement, same type of agreement is there. For example, I am the importer in India and I am purchasing the goods from US. I have to make the payment in US dollar after 3 months. But I am unsure what will be the rate, exchange rate after 3 months. So I enter into a futures exchange. There after 3 months, what is the rate applicable for converting Indian rupee into US dollar? That is given there. So if it is suitable to me, I will enter into an agreement. Where another party is there who is the seller of the foreign currency. The seller of US dollar and the buyer of US dollar. Both will enter into agreement that after 3 months I will buy 100,000 US dollar at a price of rupees 87 per US dollar. Example I am giving like that. So buyer will agree to buy and the seller will agree to sell the particular commodity, that is particular currency, at a specified price at a specified date. The currency future contract are traded on a recognized exchange which establish and enforce the rules of trading. That means a third party is there to look after that both the parties are complying their obligations or not. In forward contract, there is no third party, only two parties, buyer and seller. But here what is happening? An exchange, for a future exchange is there. That will see whether both the parties are complying their obligations or not. That means there is some security in this type of contract. Future contract are standardized agreement, means we cannot change according to our terms. Everything is fixed by the futures exchange authority, that is clearing house. So we cannot, unlike forward contract, in forward contract the parties will decide all the terms and conditions, which currency, which rate, which place, everything will be decided tailor-made, whereas this is not tailor-made, it is standardized. Now in this contract there is an exchange party known as clearing house between the buyer and the seller to trade, usually to avoid risk of failure of payment of any party. Why this clearing house? Clearing house is nothing but the exchange. The clearing house is there to look that both the parties are complying all the terms and conditions and no party should make any default in completing their obligation. To look after both the parties, clearing house is there. This contract can be easily converted either from long position to short position or from short position to long position. This is very important feature of futures contract. That means easily one party, for example, if one party has entered into a long position. Long position means buying an instrument, buying the currency. Contract to buy the currency, long position. Sell the currency, short position. Seller is called short position, buyer is called long position. So here in this case, futures contract, at any time, the party can switch over to the other position. If he has taken a long position, he can take a short position afterwards, before maturity. If a person has taken a short position, he can take a long position before maturity. So at any time the parties can switch over from long position to short position or short position to long. Hence these contracts provide adequate liquidity, whereas there is no liquidity in case of forward contract. Here there is liquidity. Majority of people prefer future contract over a forward contract as they usually trade through exchange. There is no security, there is no guarantee in case of forward contract. At any time, one of the party may not complete his obligation. So there is always a default risk attached in forward contract. But here there is no default risk because one authority is there to see both the parties are doing their rights duties or not. That's why majority of people will prefer future contract rather than forward contract. The future contract will not only be for currencies but also for securities and financial instruments. Just now I told you, we should not think that futures is there only for buying and selling of currency. No, it can be used for any of the financial instruments like shares, debentures, bonds, or any financial instruments. There may be futures contract. Now the futures contract also specifies the day when the exchange is taking place and also the delivery time. On what date, at what time the contract will be, completed. That will be specified. So these are the points which I have explained. You can be able to remember those points, understand those points regarding what are futures contract. Now I am going to explain you about the features. What are the characteristics of this futures contract? The first characteristic feature is recognized exchanges. The future contract is not OTC, over the counter. Forward contract is over the counter. What do you mean by over the counter? At any place the contract can be done. By sitting at our drawing room, by sitting in a hotel, having a cup of tea, and we can make a contract. So there is no specific place where forward contract should be done. But in case of future contract, the future contract will be done in a recognized exchange. It's a government recognized exchange. These contracts are not traded OTC, over the counter. These exchanges provide a sense of security to the parties entering in such contract. That means, when the contract is entered in a recognized exchange, then what will happen? The parties will feel some security that definitely the other party is going to comply it. There is no default. That is the security, sense of security the parties will get. Recognized exchanges. Secondly, standardization. Everything is fixed. We have to go there and find out whether it is suitable or not. Just like if you want to have a shirt, you can have a shirt either by purchasing a cloth and giving it to the tailor. So the tailor will make according to your requirement, according to your expectation, design. Accordingly, the tailor will make. The other alternative is you go and buy a ready-made shirt. So everything is fixed. You cannot change it. Simply you have to see whether it fits to you or not. If it is fitting you, you purchase it. Same is the case. Everything is standardized. The price, the date, the quantity, everything is specified. Simply the parties have to see whether it is suitable to them or not. Standardizing. Third, clearinghouse. Clearinghouse is the third party to the contract. That is the exchange. So at the time of entering into the contract, the exchange authorities, also known as clearinghouse, they have fixed the terms and conditions of entering into the contract. So both the parties, buyer and seller, have to comply all the terms and conditions given by the clearinghouse. Next is margin requirement. The exchange authorities, that means this future exchange authorities, will fix a margin requirement. Margin requirement means at the time of entering into contract, the buyer and seller has to keep certain amount in their account. They have to open the account. The buyer and seller have to open the account with the exchange authorities. The exchange authorities will credit the amount paid by the party. And every day, whatever the loss or gain arises, that will be adjusted in the account. So before entering into the contract, margin requirement is there. There is no margin requirement in forward contract. Next one is marking to market. In case of forward contract, the profit or loss will be known only at the time of maturity, not before that. But in case of Future contract, the daily profit or loss will be calculated by the exchange, by the clearing house. One party will gain, the other party will lose. That's why one account, either buyer or seller, one party's account is credited, the other party's account is debited. The loss of seller will be a gain to the buyer, or loss to the buyer will be a gain to the seller. Like this, every day profit or loss will be calculated according to the movement of the prices, and that amount will be recorded in the account. That is called marking to market. Daily profit or loss are calculated and recorded in the accounts. These are the characteristic features. One more, rare exchange of currencies. In case of future contract, very rarely actual currency will be purchased and sold. But majority of cases, what will happen, just before the maturity, the party will take a reverse or opposite position. Suppose I have taken a long position, you have taken a short position. Our contract is just for 3 months. Just before 3 months, I will make opposite my position. Earlier I have taken long position, now I will take a short position. Similarly, the other party, have taken a short position earlier. Now before maturity, they will take a long position. In this way, the original contract will get cancelled. So very rarely actual delivery of currency will take place. Majority of cases, it will be nullified before maturity by taking a opposite position. That's all. So I have explained you about the features of futures contract. Now advantages. Few advantages, limitations are also there. Advantages: reduce risk caused by price fluctuation. Every multinational company is exposed to the risk of price fluctuation. The exchange rate may fluctuate, due to which the company may gain or the company may lose. To protect the business, this future contract is one of the important tool and technique. Next is hedge against basis risk. Actually, basis risk means the risk which arises due to a particular action. Like for example, exporters and importers, they are exposed to this exchange rate risk. So they will see how much risk is there. In our business, we have to pay 100,000, $1 lakh to US firm. So our basis risk is 1 lakh. So we enter into a futures contract for $1 lakh. That means we can be able to hedge our basis risk, right? This is one of the advantage. Third is low transaction cost. The transaction costs are very low. At the time of entering into contract, very low amount has to be paid in order to enter into the contract. That is also the reason why many people will enter into a futures contract. Clearing mechanism. One of the important advantage of this future contract is there is clearing house. The clearing house will act as a monitor to the parties that they are complying with their obligations or not. Last one, low margin. The margin is also low. That is the reason why many people will enter into this future contract. Lastly, I am going to discuss about the disadvantages. Don't think that we have only advantages of future. It has some disadvantages. The first disadvantage is partial hedging. That means we cannot eliminate the risk, but we can minimize the risk. By entering into futures contract, the risk of the business cannot be completely eliminated. It can only be reduced, minimized, complex in nature. If you compare forward contract and future contract, forward contract is very simple, easy to understand, not much complication. Whereas in case of future contract, many technicalities are there. Like marking to market is there, like margin requirement is there, clearing house is there. So many technical, issues are there in entering into futures contract. Next one, not customized contract. The contract is not according to the requirement of the parties. That means everything is standardized in the exchange. We have to see whether it suits to us or not. Whether it is suitable to us or not, we have to see. The parties cannot dictate their own terms and conditions, standardized. Next one is over trading. When the margin is very low, many people will become, many traders will make over trading. That is also one of the problem. Last one is short maturities. Normally futures contract will be entered only for short maturity, 1 month, 2 month, like that. Normally it will not be entered for long period like 6 months, 9 months or 1 year. So these are few disadvantages of futures contract. I have explained the meaning, the definition, the characteristic features, advantages and disadvantages. So if you are satisfied, give a like to the video, share my channel and subscribe if you have not yet subscribed. Visit the playlist of my channel. I have uploaded so many different types of videos. So you can get a lot of benefit from these videos. So inshallah, I'll continue the next topic, that is options contract, in the next video.